You have said that macroeconomics is broken, that what we consider monetary policy is actually credit policy, right? The thoughts of Friedman that you have amplified today. Tell us a bit more about that.
Yeah, indeed, macroeconomics has been broken for quite a long while. In fact, what Professor Friedman says is 50 years. It's actually slightly more than 50 years. So we've been living as countries in a setup where what we're doing was not based on real science. It was based on a poor understanding of how economies work, and mostly how banks work and how money works. And since then, it's until the crisis that happened in 2008 that we began to wake up to say, but hold on a second. What are the reactions of our reserve banks? What are the reactions of governments? Oh, maybe the economy works in this fashion. And indeed in this fashion, not in the fashion that we've been thinking. So people began to realize that actually, indeed, macroeconomics was broken. And what we thought is monetary policy is actually really not monetary policy. It's supposed to be credit policy, in the sense that when an economy engages in transactions, it does not use what is defined as money. Okay. It uses credit, but credit legally is not money. All right, these are different concepts. To the extent that we've been using the term money, when in fact, and therefore going along with it and using mathematical models that talk to money instead of mathematical models that talk to credit, we've been actually not helping ourselves. Now, that realization has come up now, but textbooks continue to teach the same stuff that was taught some 60 years back. So a student walking out of a university is as dead as 50 years back, because their understanding is built on the wrong and scientific approach to macroeconomics. Hence all these massive challenges, not just in Africa, but in so many other developing countries. Remember, Europe and so on advanced not because they were practicing good macro, some did, but they advanced because of easy resources from Africa to them, all right? So one would have thought, wow, they're doing good. Actually, they're not doing good. It's just because they were removing resources from Africa and other developing countries to Europe. But actually, macroeconomics was, that collapsed a long time back. But fortunately, even these countries, like Germany, like the US itself, at the time of its development, it never used to use this type of macro. Okay? It used to use the type of macro we've been describing about, where credit is the real analysis that we can use when talking about macro and thinking about macro and indeed practicing macroeconomics.
Let's break this down for the regular person, so to say. Monetary policy, in the way it has been understood, how has that impacted the development of our economy? So we have a central bank, they have a monetary policy committee who make decisions on where interest rates should be, amongst many other things, right? CR and many other things. So how has that broken ideology of what macroeconomics is and monetary policy is, how has that played into how our nations have developed?
Profound. For example, the Monetary Policy Committee sits. Its mandate is to reduce inflation, all right, to some level. What it goes to use is an interest rate. Why interest rate? Is because there's an understanding in economics that when you use a tool called interest rate, for example, if you lower the interest rate, then the economy is going to grow. Now you have to lower it in such a way that, at least according to them, in a staggered way, such therefore the pain is not sufficient. But there's a lot of pain to reduce interest rates from whatever level to another. what we call output is sacrificed as a consequence of lowering the so-called interest rates, I mean the inflation, to some level. That's where the challenge is. You thinking you actually lowering, you're not benefiting the real economy, you're benefiting the financial economy. The real economy is the one that sees you and me advance. The financial economy, which you as a reserve bank are trying to work on, is benefiting the already rich people. That's why we see no effect, almost very muted effect, when you lower your interest rates to whatever level. You only find that the markets are bubbling.
Capital markets, right?
But when you work out the GDP, you exclude assets which are largely traded by financial markets. And because those things do not impact the real economy, then the rest of the economy suffers. So you're tightening up the interest rate, for example, all right? Because you're thinking, well, this will curb, inflation and therefore help the economy later. You're not. You're actually even reducing investment in our economy, which is dependent on very reasonable rates. So it is the opposite of what we think should be happening, but really happens. That's why our economy, even if the interest rates were to go so low, they don't really begin to grow as much as we think. I'll give you another example. In Europe, in the US, interest rates were zero at some point in time, not long ago, actually, for about a period of closer to 10 years. They realized that actually the economies are not growing. Then they began to have other measures that have nothing to do with the interest rates, have something to do with credit. It is for this reason that Professor Friedman says actually for the past so many years, we were thinking that money and obviously the interest rates are fundamentally important, when in fact they're not. So the brokenness of our economy comes from the brokenness of macroeconomic understanding. Wow. So hence the challenges. So Africa, therefore, whether it's Nigeria or South Africa, doesn't matter which country. For as long as they continue to follow the so-called interest rate issue, they will not win. At the end of the day, we are going to continue to experience challenges. And in fact, that makes the Western world very happy. Because why? They want to give us loans. All right? Why? Our economies, our currencies get low. They come and so-called investment. Actually, they're coming to dominate the local economy. When a local economy is dominated by foreigners, what happens? They take money away from your economy. So at the end of the day, all this works out very dangerously for our economies. And I think we have to rethink as a matter of agency. Therefore, even the monetary policy committee, Nigeria, South Africa, anywhere else, must begin to examine this notion of simply saying interest rates are the primary vehicle for stimulating the economy and heading the economy now.
And let's come to Nigeria. You cited the example of how Europe approached this. In Nigeria, we have had, since COVID, Russia-Ukraine inflation at record highs. And as a weapon against inflation, or to temper inflation, interest rates have been hiked, elevated for years. We just started an easing cycle, and the next decision will be made shortly, I believe. But what we've seen is that while inflation may be tempering down, and that could also be because of rebasing, the reality, the everyday man cannot relate to the reality, right? Interest rates have been higher, hot money has been coming in, right? FPIs, and that has given us a false sense of security. Our capital markets is doing well, but the real people, the predominant majority of the people, are not feeling the benefits, right, of all of these policies. So how do you said the system is broken, you said what we think is monetary policy is credit policy. You've highlighted the need to rethink. In what direction should we begin to think out our policies in easing inflation and creating real change? What substitutes are there?
It's an extremely important question. And at the center of it is whether you and me as Africans are going to improve our lives or not. You said there was an interest hike in Nigeria a while back to curb the inflation which was quite high. But look at the type of inflation that Nigeria, South Africa, and whoever else was trying to fight. It is a supply side type of inflation, meaning inflation that has little to do with Nigeria itself, the demand in the market. It has something to do with some forces elsewhere. So even if you hike interest to fight this type of inflation, you're simply killing the economy because that inflation does not respond to the interest rate. Okay? In fact, why the inflation has been going down in Nigeria and South Africa and so many other places is because the easing of the supply conditions caused by the Ukraine-Russian war and so on and so forth were happening somewhere else. All right? So when that need to push up interest rates is made on the conditions that don't necessarily require you to push up rates, you are effectively destroying your economy. Instead of using interest rates, economies in Asia, what they did is they didn't use the Reserve Bank. The Reserve Bank was monitoring those things. They used the central government to ease conditions in the economy so that they don't punish them.
Credit.
Yes.
Okay.
All right. They use credit, so the Treasury, the Ministry of Finance, and other ministries like the Ministry of Trade and Industry and so on and so forth, those are the instruments, they're instruments that are needed in an economy when inflation of the supply side comes to kick in, not the interest rate. When you increase the interest rate, you're making the bank so heavy. All right? So there, the financial sector begins to get bubbly. All right? And the capital markets jumps up.
Yeah.
They become so excited because first they're making money out of the interest rate. And because the interest rates are so high, there's little that you and me can do. They dominate the economic activity. And therefore, at the end of the day, we end up suffering. Now, the best way is for when you have high interest rates coming because of external factors, let the Reserve Bank remain mum, because the moment it raises interest rates, killing domestic economic activity. Let the ministries of commerce, or trade and industry, and the Ministry of Finance pump in money into the economy.
Which could trigger inflation?
No, it doesn't.
Because there's also that ideology that more money in the economy is what also drives inflation.
But this is exactly what I was saying. That they think that when you increase money, then what increases this side is not the output, it is inflation. That's what the economics has been telling us. The economics tells us when you increase money here, what comes out here is actually inflation. No. Unless you increase money in an unproductive way, in an ignorant way. I was giving an example of Bangladesh. What they did, what the Reserve Bank governor or the Bank of Bangladesh went, instead of skyrocketing the rates, he even said interest rates are not the tool here. I'm not going to punish my people with high interest rates. I'm going to take money to the various sectors that are important in the economy and cap the interest rates to a certain level. And he therefore demanded that banks do not lend to you and me in the textile industry, you and me in women industries, you and me in agricultural industries, not at this high rate, at this low rate. Therefore stimulating the economy while the interest rate is actually being lowered by decree as well.
That was credit policy.
That's the credit policy. That what the governor was doing was sending money which the quality money is not actually money, it's credit to the real sector of the economy, which begins to grow, at the same time alleviating the challenges of people as a consequence of the high interest rates. Mm-hmm. So I think unless we begin to reverse that or disorder, interest rates are intended to fight the demand side of inflation, where there's so much consumption in the economy. You're buying so much, there's so much, activity in the economy, and therefore inflation. But the inflation in Nigeria was not because there was so much buying left and right by Nigerians. No, it was because of the Russia-Ukraine war, which had absolutely nothing to do with the locals. And you can't fight that type of inflation with high rates.
So definitely a need to rethink that. You've also highlighted the role of banks, and you have said their role should be more social than, I would say, profit-making or commercial. How has the way banking in Africa has been managed, how has that affected our economy? And again, why should banks, and how can you make banks, because they want to make profits, right? They have shareholders and all of that. What can we do to ensure that banks play a more social role in driving the local economy?
What I was trying to say is that banks create money. All right? Money is the prerogative of state. No person, whether we like it or not, can go and begin to create money. In whichever way we want to define money first, because money is a creature of state. Now, to the extent that a bank has been licensed to create money on behalf of the state, it must therefore obey the policies of the state. The state must exercise its authority because it has licensed you to perform its job. But the job of the state is not to make profit. The job of the state is to make you and me grow up in living standards and so on and so forth and get wealthy. Therefore, the banking system has been let out of the hook in Africa because of our understanding of what money is and our understanding of what banks do. If the governors of our reserve banks understood properly, they would in fact be saying to banks, like the Bangladeshi government did, there are so many small sectors in the Nigerian economy that are starved of credit. Begin to distribute credit in that direction. But only credit that's going to be productive. So our failure to fully grasp the role of banks is what has given the banks so much power against the very people who have licensed them to do the job of the government. Unless that is reversed, it's not possible for our economies to survive because our economies are dependent on banks. Banks, in our own conception, is that they collect money from savers, all right, and then take the same money and lend it over to us. That is a financial intermediation role. They're like a post office, all right, that collect letters and send letters to the people. Banks don't do that. Banks create credit. They create money. That money is authority to be created. Authority is the state. The owner of that authority is the state. And unless the government understands that it has the prerogative to create money, and which prerogative has been given to the public banks, then all is going to be in a mess. Now, you raise the important issue of saying banks have got shareholders and so on and so forth. That falls under, when you say a bank is a financial intermediary, it's like any other company. So the theory that applies to a bank is what we call a firm theory, a theory of firms. Like I was saying, it's the same as a theory of Coca-Cola, a theory of Kentucky, and so on and so forth. But that shouldn't be the case. The appropriate theory to be used, and therefore to curb the excessive profits of the bank, they are not accountable to shareholders. They're really accountable to the person who gives them the license. And that person is you and me as state. And therefore, they should be playing a societal role. The word institution is key in our understanding, and therefore thinking of how we should organize our systems.
Right. So,
If we think of them as institutions, meaning organizations that play a societal role, then we're going to have to curb so many things. In fact, if you remember not long ago in the US, there was so much profit being made by banks. And then there was this outcry that, no, we should rein in this type of profitability.
right.
It's the social function which says you cannot be manipulated. Otherwise, then we have only banks getting rich and the rest of
Right,
us.
right. So I think it also speaks to your point on banks as institutions and not as intermediaries.
Exactly.
Yes. Thank you so much for your time, Redge Nkosi, the Executive Director of FirstSource Money.
Thanks for having me.
A pleasure.
Cheers.